Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I'm Abhishek Ranjan. Joining me on the show today is Vatsal S. Shah, Head Wealth Management at Sushil Finance. Welcome to the show and thank you for joining us. Now, before we begin the show, let's take a look at the winners and losers of today. Every day, as promised, we bring you the top funds in market cap and thematic categories. While it is important to stay invested for a reasonable period of time to make money, it is also important to track fund performance. They are now flashing on your screens. Let's begin with the query that we've received from G. Vijay Kumar from Chennai, who's emailed to us his query. He asks, what are the strengths and weaknesses of debt funds? Can one find opportunity in the current crisis surrounding debt funds? So over to you, Vatsal. But this is a very pertinent question that a viewer has asked. In the ongoing sort of carnage that we are looking at when it comes to the debt space. What would be your response to this query?
Right. It's a good question by Mr. Krishnan. And so basically, a debt fund is nothing but a fixed return product, which is designed in a way so that it is more tax efficient, and that is the shortest definition of a debt fund. So it ultimately gives loans via NCDs or debentures or bonds to other companies. So if it could be either a government or it could be a corporate, and based on the mix, there are different types of debt funds. So the strength here is that if you hold it for 3 years, you get post indexation, you get tax. So you get tax free benefits, almost tax free, because you get indexation benefit in the gains over 3 years, which is not there in any fixed return product, considering like any interest bearing product like an FD, or if you take the debenture yourself directly from the market, you're not going to get that benefit which you're going to get through a debt fund.
That's right.
Second thing is, it is also beneficial if you are investing for a very short period, which is say 2 months, 3 months. FDs generally have penalties if you withdraw your money quickly. Though now they are also coming out with innovative products, but the returns there are much lesser compared to the ones you can get over here through a low duration or a ultra short duration fund. So these are the benefits of a debt fund. In the current market crisis, one should actually stay a little away, because right now things are not clear. So one should stick to more of the government securities and purely government oriented PSU AAA bonds. So PSU and banking debt funds is something they should look at, and not just get into a very risky credit risk fund.
So staying away for now is the advice that you're giving. But does a debt fund still, should it find a place in your portfolio even at this juncture when the backdrop itself is very murky when you look at the debt side?
So
of
definitely, how I look at it is that it's always safe to enter Taj a day after the terrorist attack and not before. So now the whole the fail-safe mechanisms are so strong at the mutual funds end that the chances of losses going forward are going to be very minimal, and even the credit rating agencies are on tight watch by the SEBI. So all those things, all the fail-safe mechanisms are now in place, and this is in fact, for a contrarian investor, it's a very good time to enter into the debt fund. But someone who is not very aware about the products should just stick to a liquid fund or a liquid plus kind of fund.
All right. So I hope we've addressed Mr. Vijay Kumar's query here. On to the other query that we've received from Ankit Nakwa from Jamnagar. He's emailed to us his query. He's investing through a SIP rupees 1,000 in each Aditya Birla Sun Life Frontline Equity, SBI Small Cap and HDFC Mid Cap Opportunities Fund. Now, he's also invested through lump sum in HDFC Hybrid Equity and ICICI Prudential Equity and Debt Fund. He says, investing for my daughter's education and marriage. My time horizon is 20 years. What changes does my portfolio need? a very typical mutual fund investor.
Right.
So what would be your
So
advice?
all in all, his fund selection is decent. So he has a mix of large cap, mid cap, and balanced funds as well. I would only suggest that since his horizon is 20 years, he should look at reevaluating his balanced funds. Maybe not in today's market, because today equity and debt are both underperforming. But over the next 1 year or 2 years, once you have some returns from the balanced funds, you can actually move it out to a multi-cap kind of, because you have a long time horizon, and over 5 years, all the equity oriented funds will end up outperforming the balanced funds. So that is one piece of suggestion for him. With 20 years, he will accumulate somewhere around 50 lakhs with the kind of investment he is doing of 5,000 rupees every month. So if that is good enough for his daughter's education and marriage, considering inflation, then it's fine. But he should then recalculate if he feels that he needs more money for daughter's education and marriage.
So he's doing fine with the kind of.
He's doing fine, and he will gather conservatively 50 lakh rupees. If that's good enough for him for his goal, it's great.
All right, so that's the advice, and hope we've addressed your query, Ankit. Now on to another query, and we are being now joined by Sachin, who's online from Hyderabad. Please go ahead and ask your question here to Vatsal.
Good afternoon.
Good afternoon.
I am Sachin from Hyderabad, aged about 43 years. Well, I have two goals. One is a midterm goal. Goal is to reach about 10 lakhs. And the horizon is about 3 to 4 years. I've already invested about 6 lakhs in the below 5 funds, Axis Blue Chip Fund, about 1,20,000. HDFC Top 100, 1,80,000. SBI Banking and Financial Services, 60,000. Mira Asset Tax Saver, 1,20,000. And ICICI Prudential Equity and Debt Fund of 1,20,000. So that's a short-term goal. In terms of long-term goal, I would like to accumulate a corpus of about 2.5 crores in the next 15 years.
Okay.
And the likely actions that I am planning is to invest about 1,62,500 in lump sum for the below 4 funds. This would be exclusively, direct funds. And these below 4 funds, which I plan, is the Mira Asset India Equity Fund, Aditya Birla Sun Life Equity Fund, Kotak Standard Multi-Cap Fund, and Franklin India Prima Fund.
Okay.
So apart from this lump sum investments, I would like to pursue with a SIP of 9,000 each or for the above 4 funds, and also go with a debt fund with Kotak Savings Fund with an additional 5K. That sums up to total about 41,000 per month for the next 15 years.
Okay.
Please advise if the portfolio is good enough, or are my goals achievable or feasible?
Sure.
So multiple levels and multiple time horizons he's looking at.
So Sachin, we'll break up your question into 2 parts. So your first question, which is about your lump sum investment and a short-term goal of 10 lakhs. So you have invested somewhere about 6.5 lakhs in various funds that you just named. The selection of the funds are decent. They are more so on the large cap side and the large and mid cap side. So they are only large cap and a balanced fund and a tax saver. So what I would suggest is that in today's market scenario, where 80% of the returns have come only from large cap, it's prudent to move something to a multi cap or a mid cap also, because there the downside is limited, and you have a little aggressive goal that in 3 years you want to make your 6 lakhs to 10 lakhs. So that's slightly aggressive. It is achievable looking at today's market condition if you have that leap of faith. But then I would suggest you migrate to one of the mid cap funds. So Kotak Emerging Equity is a good fund which you can consider to add to your portfolio. That is about your first part. Coming to your long-term fund requirement of 2.5 crores. So the 15-15-15 rule says that if you invest 15,000 rupees for 15 years, you will end up making a crore if it compounds at 15%. You want 2.5 crores. So if you back calculate, you need somewhere around 40 to 45,000 rupees in a pure equity 15% compounding fund. Right now you are looking at investing 36,000 rupees. So you may fall little short. But considering you may have some limitations, you can reevaluate your amount over after every 2 years or 3 years based on your income as well. So coming to the funds that you have selected, which is I believe Mirai Asset India Equity, then you have Franklin India Prima Fund, and you have ABSL Equity and Kotak Standard Multi-Cap. So these four funds are pretty much again good funds, but my view or opinion about the mid-cap will continue to stay. I think you should add a mid-cap fund also to this basket as well. And you can continue the same fund which I recommended, Kotak Emerging Equity. It's a great mid-cap well-managed fund, and it's not too large as well, so the fund manager has good room to play around. You can also look at Canara Robeco Emerging Equity Fund, which is also on a large and mid-cap space. So these two funds would be my recommendation to you for your two goals.
All right, so that was a query from Sachin, and Vatsal did respond to it. There were two parts to the query that Sachin had. One was, of course, to meet his short-term horizon, wherein the suggestion was to migrate to a mid-cap fund. And for the second part of his query, wherein he had a long-term focus, you suggested that he needs some top-up to the existing funds, and also some suggestions coming in on newer funds, recommendations from Vatsal. Now moving on and taking another query from our viewer Avik Saha from Bengaluru, who's emailed to us his query. He's 28 years old and wants to start investing for 25 to 30 years. He wants to start investing through a systematic investment plan of rupees 2,500 with an annual increase in the following funds: Axis Blue Chip, Mirai Asset India Equity, Mirai Asset Emerging Blue Chip, Canara Robeco Emerging Equities, and HDFC Children's Gift Fund. He says, want to accumulate rupees 5 crore for my investment, for my retirement. I'm a moderate risk taker. How's my investment strategy? Should I allocate SIP top-ups to same or different funds?
Okay. Good question there, Avik. And since you're young, it's good that you're planning for a 30-year. We all hope that we had that same advice when we were that young. But coming to your fund selection, I just want to understand, for your perspective, I would like to say that you really don't need a children's gift fund even if you have a child. So, you know, if it's a very contrarian statement for an advisor, but the children's gift fund is largely for those who want to allocate large sums of money as gift for their children or their next generation. But for someone who is looking to do an SIP, a pure equity fund would be the best way to actually gift. Now, I'm assuming you have a child, but if you don't, then you definitely don't need this fund at all. So you can drop the children's gift fund from your selection. The fund is good, but it probably doesn't meet your need. In that case, coming to your other fund selection, they are all large cap funds again. So you really need a good multi-cap fund and a good mix of mid and small cap as well. So because you are young, I would suggest you to take slightly higher risk. You can look at a small cap fund as well in today's market. And again, I would stick to Kotak Emerging on the mid cap side, and on the small cap side, Axis Small Cap Fund is also a very good, well managed fund. So you can have a look at it. IDFC Sterling Value is also a good, small and mid kind of a fund to be looked at. So these two suggestions would be from my side.
All right, Vatsal, Avik's query and your response was, the key one, of course, was to revisit the allocation and maybe consider revisiting the allocation to the Children's Gift Fund. And on the final query before we wrap this up, Dinesh Bhardwaj from New Delhi has written to us. He's retired and investing via SIP rupees 10,000 altogether in Aditya Birla Sun Life Equity, Franklin India Focused, SBI Magnum Multi-Cap Fund, SBI Focused Equity, SBI Blue Chip, HDFC Mid-Cap Opportunities Fund, HDFC Hybrid Equity Fund, SBI Equity Hybrid, and Aditya Birla Sun Life Tax Relief 96 Fund. He says he wants to reduce multi-cap schemes to one or two, want to accumulate rupees 30 lakh year, 30 lakh after 10 years for my grandchild. Want to initiate SWP of rupees 5 to 6 lakh every 2 years after 2021 for traveling abroad. Can you please guide me?
Okay. Yeah, Dinesh, good set of questions there. Coming to your fund selection, you have a mix of say SBI, Aditya Birla, Franklin, and the likes. So all HDFC also. So these are differently managed fund houses, and I think you can continue to hold them because the strategy or the investment philosophy used by the fund managers in all three are starkly different. This would be helpful because all will not perform at the same time. So in different markets, you will see different funds performing. If you want to cut down, you can consider cutting down the SBI Focused Equity Fund. It has performed really well, so it's more of a profit booking action that I'm suggesting you. It's not that you have to stay out of the fund. It is also the returns have been driven by Alphabet, which it owns Google. So we suggest that funds who have done really well based on US stocks, one should now look at India because India is more cheaply and attractively valued. So given that, you can look at migrating that to any of your other funds, but I would suggest to keep the other funds as they will give you returns at different time frames. Coming to your second part, which is about for the SWP, so removing 5 to 6 lakhs every 2 years, you have to also consider that every 2 years your cost of your travel will also go up. So you need a corpus of about 45 to 50 lakhs, which can compound at 8%, and you can remove this kind of money timely so that your principal stays intact and you can also enjoy your travels. If you have gathered or collected that kind of a savings, it is possible, very much possible, to do it through a SWP route in a balance fund, because balance will give you best of both, and right now both are underperforming, equity and debt. So you can park that entire money in a balance fund and you can start taking out. You already own SBI hybrid and ICICI equity and debt. You can add to that as well and start taking your SWP out every 2 years.
All right. Thank you, Vatsal, for joining us here on MF Guide and helping our viewers with the queries. That's all the time we have on this edition of Mutual Fund Guide. More news and updates will continue on the other side. Keep watching Business Television India.